Today we have Sahil Kapoor, Chief Strategist of DSP Mutual Fund, who's joining us on the show. Sahil, good afternoon. Thank you very much for your time. I'll start straight away with the most contentious issue in the market. While the large caps have come back after a brief hiatus and a sideway consolidation, but it's the small cap, mid cap, which on the one hand people are saying, no, not at all, they are not overvalued. Why the caution? But some old timers are saying, well, this happens all the time. Time to be cautious. Valuations cannot be justified at current levels, at premium or at par with large caps. Which side of the argument are you on? And more importantly, what are those indicators for which you are actually asking your investors to exercise caution?
Good afternoon, Ajay. And I remember we spoke in Feb, and there was this question about mid and small caps. And at that point, our view was very clear that small and mid caps were attractively priced. And we also discussed not only in India, but globally also. And since then, we've seen a very large rally. And let's look at what is the extent of the rally. So on 28th March 2023, small cap 250 index, Nifty 250, was at 8490, below 8500. And today, as we speak, it's at about 12,375 or so, which means that it has rallied nearly 45% over the last 4 to 5 months. That has been the tearing rally that we've seen. Roughly, when I looked at the data, it's been about 24 weeks without any 3% fall. The index has rallied, which is quite rare. So what this has done is it has brought back most of the small and mid cap indices slightly above their long period average valuations. Although I don't think average valuations do make a lot of difference for some of these stocks, but there are a number of signs clearly which tell you that pockets in mid and small caps are overheated. And let me highlight 1 or 2 data points for you. One, as I said, this is, I think, about 5th month of rally for small and mid cap stocks. Usually we've seen 6 and 7 months is where they tire out historically. Second, when you look at, let's say, the weekly momentum oscillators, for many of them, they are hitting extreme readings. We haven't seen them for a very long time. A third, of course, they have exited that cheap valuation zone that they were at the beginning of this year. They are no longer there. Thirdly, I think when you look at the market as a whole, when you look at the large caps, they are also not in the cheap zone anymore, right? So when we were at 17,000, there was a clear, comfort in terms of valuation. That comfort is no longer there. We are now trading in the top decile valuation that we've seen for Nifty for a very long time. So the conclusion is, I think right now we are hitting some sort of extremities. It's good to be cautious here, exercise caution rather than adding your incremental rupee to equity investments. You could probably look at multitude of other opportunities. And I think right now is the time to tone down expectations rather than being overtly bullish from the current levels.
Sahil, fair point. I hear you very well. But I want to understand, typically from these kind of zones, both on valuation and other metrics, in the next 3 months, 6 months returns, do they turn flat? Do they turn negative? What are your reading of historical patterns actually tell you?
Sure. So Ajay, we looked at data, and the data was very surprising that when you buy Nifty, if it is trading at a price to earnings ratio of more than 22 times, the 3-year forward returns are 8%. But when you buy Nifty, when it is trading, it's on its average valuations or lower, which is below 20 times or so, the forward 3-year returns are more than 18%. So it pays to increase your equity allocation when they are cheaper. And history shows that when you buy when valuations are expensive, usually your forward experience is not so great. So I think we are somewhere close to that bucket. And I was also reminded of some historical data points. So I'll take you back in history. On 25th November 2007, Nifty was trading at 22.7 times trailing earnings. And today morning, it was trading at 22.7 times trailing earnings. So if you were sitting in November 2007, everything was rosy, and nobody would have expected that market will see a crash in the next 2-3 months. Even today, we have no signs or any data points or any indication to tell us. But history has always taught us that when markets are expensive and in the top decile or top 20% of their valuations, exercising caution is much better. And when they are cheaper, being more aggressive is more logical. I think that is where this data point sits in today. And second, and when you look at from earnings perspective, when the Q1 results came in, about 30% of BSE 500 companies reported top line contraction, which is not a very common data point. What saved the earning picture was, of course, improving margins. Margins have improved at a very fast clip. And I think they will improve in the next quarter also. But according to my estimates, there is going to be more than 1/3 companies reporting top line contraction. So
Fair
there is
point.
a lot more push and pull happening in the market right now.
Sahil, that's a very interesting reminder which you have brought forward for our viewers that in 2005 November we were at 22.7 trailing Nifty.
2007. 2007.
2007, sorry. 22.7 times trailing price to earning, and this morning we were there. What a reminder. Because those who don't learn from history tend to repeat the mistakes. We are not creating any panic over here, but the idea is to have best returns possible in your portfolio strategy. From current levels, the next 3 year, if you put money at current levels, the next 3 year returns would be just under 10%. But what should be the ideal strategy right now, Sahil? Is it just an India-centric approach which is turned cautious, or globally you see a case of pullback getting stronger because higher for longer perhaps is not fully digested, or any other factor?
Ajay, I think in last 20-25 years, what we have seen is that India and US has delivered excellent returns. Both these markets have been, on a sort of a tier in different parts of the decades, but they have delivered very, very good returns. For example, India's own returns in last 20-25 years are between 12 to 14% CAGR, whichever number you look at. US returns have been upwards of 11% CAGR. So excellent returns from these two markets.
Sahil, you were making a case whether it's just a India market specific headwinds which you see, or globally too things could get shaky in the middle.
Yeah, I think there are pockets in US also which are quite pricey. When you look at technology as a space, I think trading at 25, 26 times trailing earnings, they are not cheap. History says that when you buy them, Nasdaq over a 3-year period hardly makes any money. Similarly, US large caps are trading at 20 times trailing earnings, so not very cheap. But when you look at small cap in US, they are trading at absolutely below average valuations of 14 times or so. Currently, when you look at the globe, it's not a very synchronous picture. I think each country, each index is trading in a different zone at different varying valuations. Particularly in large parts of the world, small and mid caps are still trading cheaper than large caps and at a very large discount. So no, I don't think it's a widespread phenomena. You won't be able to paint it with the same brush across the world. But I think you will have to exercise caution where stocks are expensive. You have to make sure that your portfolio does not have many expensive companies because, as you said, rates are still very high. Quantitative tightening has started. So very expensive companies most likely will deliver below par experience to investors.
So does that mean that rates may also tend to remain higher for longer for investors, HNI and retail? It may be a smart strategy to lock in some of the part of the portfolio at higher rates, which may not last beyond six months or so, 6 to 8 months.
Ajay, lock-in, yes. We have also, exercised a view that buying India duration makes sense now at 725, 10-year GSEC. It makes sense to lock in some yields here. We believe that possibly rates will head lower. Maybe they will remain here for some time. Higher for longer, I'm not sure. We see that data is weakening across the world in terms of, nominal growth is coming off. Inflation numbers are going down. So maybe in the next 6 months to 9 months, we'll see inflation will become less sticky where it is right now, and then probably rate could fall. So locking in rates could be a very good strategy right now. The idea should be to look at assets other than equities also to get into the mix. I think most of the investors also are most of the times overweight on equities, or at least have appropriate amount of equity in their portfolio. The idea at this point is to look at other assets to get in the mix.
So if indeed next 3 to 6 months does provide a good kind of a corrective phase in the market, however shallow or sharp it might be, that is something for us to watch out for. What are those areas of the market where you see business fundamentals improving sharply, the underlying strength in the quality of numbers, etc., where these dips should be taken an opportunity to deploy extra funds?
Sure. So, Ajay, within equity, I think there are still clearly sectors which are still attractive, like healthcare. I think that has been one of our calls for over the last 1 year. We believe that there is still value there. The cycle is just beginning to turn. It'll maybe take another 2-3 years for it to fructify overall. Second, of course, is BFSI. I think if a correction occurs, that sector itself is still trading below average valuations, in spite of the rally that we've seen in last 1.5, 2 years. This calendar year, we haven't seen a very large move unfold in BFSI sector. That again, I think will give a lot of opportunities. Within auto, we think two-wheelers is becoming an attractive bet where some opportunities are coming up. So these are some of the sectors, but I think we can also go outside equity and maybe, get to something like a gold where we think allocations will make sense. Just to give you one very interesting data point, we did a study, looked at all emerging markets globally. All means every single emerging market. Gold has beaten domestic equity returns in local currency in every single emerging market in the world over the last 25 years, which is an amazing piece of data given that we spend so much time looking at equity markets, but one single yellow metal beats all of them across emerging markets. Even in case of India, the returns are very close to each other. Gold returns and equity returns are not very far off. Although if you manipulate the data a lot more, they will get even closer or gold will beat. But the reality is that gold has trailed equity return in India, but by a very, very slim margin. So it makes sense to mix these assets together, not just equity sectors, but look at gold also as a asset class to diversify into.
Sahil, thanks very much for those very interesting points, very unpopular view, but very strongly substantiated with your arguments. Well,
Thank you.